Welcome to today's class, students. In the previous class, we learned about simple interest and we did the exercises related to simple interest. And I asked you to complete the other questions which we did not discuss in the classroom. So I hope you would have done all those questions and we will discuss it in the upcoming classes. And today we are going to learn about compound interest. So compound interest, simple interest. So both of these interest are usually calculated when you go to banks. You can understand how they are calculated, and it is widely used in the financial sector. So let's find out how we can calculate compound interest and how we can use it in our day-to-day life. An alternative way of calculating interest for an amount of money borrowed or deposited is the compound interest method. Let us explore how the interest is calculated under this method through an example. At a bank that pays an annual interest rate of 10%, the account statement provided at the end of 3 years. To a person who has maintained a 25,000 rupees fixed account is as follows. So a person who maintains 25,000 fixed account is getting the interest, an interest rate of 10%. And that is got for 3 years. And he is receiving the interest at the end of 3 years. So let's see how it is calculated. So the dates are given here, the very first day of the year 2013, and then the end of 2013. Then again, the first date of the year 2014, end of 2014, first of 2015, end of 2015. Then again, the first date of 2016. So the description also shown here. The cash is deposited on the first day of 2013, which is 25,000. Now at the end of the year 2013, his account gets an interest of 2,500. So since the interest rate is 10% annual rate, is getting the 10% of 25,000, which is 2,500. So the balance as of 1st January 2014 is 27,500, because with the 25,000, the 2,500 will be added, and that will be the balance on the first day of 2014. At the end of 2014, the last date of 2014, he will receive an interest of 2,750. So that is the 10% annual interest of 27,500. Now that will be added with the balance, and he will receive a total balance of 30,250 at the beginning of the next year, the third year, which is 2015. So at the end of that year too, he receives the 10% of interest, which is 3,025, and that is added with the 30,250 at the end of the year. So when the account goes for the next year, the first day of 2016, the balance will be 33,275. So the description is shown here, and you can see in this manner, when the interest is calculated every year, not only the principal but previously earned interest also earns interest. So this is like interest to interest. So in the first year, he received an interest, and in the second year, he received the interest for the interest which he has already earned in the previous year. The addition of interest to the principal is called compounding, and the interest calculation on the compounded amount is called as the compound interest method. So this method is what we call as compound interest method. The compound interest method can be used when calculating interest on a loan as well as on a deposit. So you can calculate the compound interest for a loan as well as on a deposit. Example 1. If a person takes a loan of 10,000 rupees at a compound interest rate of 10% per year, calculate the total amount required to repay the entire loan in 2 years. So the loan amount is 10,000 rupees and the compound interest rate is 10%. So interest for the first year equals 10,000 times 10%, which is 10 over 100. So that is 1,000 rupees. Loan amount at the end of the first year is what you get by adding the interest of the previous year with the capital amount or the principal amount. So that is 11,000 rupees. Interest for the second year is calculated for the balance, which is 11,000 times 10 over 100. So that is 1,100 rupees. So that will be added with the principal amount of 11,000, and that is the balance at the end of the second year. So as in the above example, compound interest can be calculated separately for each year and added to the loan amount to find the total loan amount due. So this will be the amount, 12,100 will be the amount that he has to repay at the end of 2 years. Example 2. Amal invest 50,000 rupees for 3 years in a fixed deposit account, which pays 6% annual interest compounded yearly. Nimal invests 50,000 in an account, which pays 6% annual simple interest. Calculate the amount received by Amal and Nimal at the end of 3 years separately. So Amal and Nimal are 2 persons. Amal is investing in compound interest, and Nimal is investing in simple interest. So you need to find the amount that they each earn or they get at the end of 3 years separately. So the total amount received by Amal at the end of the first year is 50,000 times 106 over 100. So this 106, which we got on the top of the fraction, is by adding the 6% with the 100. So 100 over 100 will be the principal amount. In addition to the principal amount, there will be an interest of 6%. So that is why it is shown as 106 over 100. So when it is calculated, we get 53,000. So that is for the end of the first year. The total amount received by Amal at the end of the second year. So second year, the balance will be 53,000 and the interest calculated will be 106 over 100, which is 56,180 rupees. So that will be the amount at the beginning of the third year. So at the end of the third year, the total balance will be 56,180 times 106 over 100. That is 59,550.80 rupees. So that is the final amount that Amal receives at the end of 3 years. Now, when it comes to Nimal, so Nimal is investing in simple interest. So interest received by Nimal at the end of the third year, we can directly calculate since it is simple interest, 50,000 times 6 over 100. times 3. So that is the total interest that he receives at the end of the third year. So that amount will be added with the capital amount, which gives us 59,000. So if you compare the two amounts, Amal receives and Nimal receives. Amal is getting 550.80 rupees more than 59,000. So that clearly shows that compound interest gives more earning than simple interest. Total amount received by Amal at the end of 3 years can also be obtained by 50,000 times 106 over 100. So that is multiplied thrice. Because on the first year, this will be the amount. And on the second year, the interest for the interest will be calculated. And third year, the interest for the interest will be calculated. So that is 59,550 rupees and 80 cents. So I hope you have understood completely about compound interest method and how it is calculated and the difference between simple interest and compound interest methods. So now let us try exercise 9.2. So I'll give you some time. Let's write down the question, the first question, work out the answer, and then we will discuss the answer. So the loan amount is 5,000 rupees. The compound interest rate per year is 5%. Therefore, the loan amount at the end of the first year will be 5,000 times 105 divided by 100, which is 5,250 rupees. Then at the beginning of the second year, there'll be a balance of 5,250. And at the end of the second year, the interest is calculated for the balance. And with the interest, the total amount to be paid will be 5,512.50 rupees. So that is the amount that has to be repaid at the end of 2 years. Now moving on to the next question. If a person deposits 6,000 rupees into an account paying 7% annual interest compounded yearly, how much money will be in the account after 2 years? So it's also a similar type of question, but the first question is related to the loan, and the second question is about fixed deposit. So the deposit amount is 6,000 rupees with a compound interest rate 7%. The amount received at the end of the first year is 6,000 times 107 divided by 100. That is 6,420. So now this interest is calculated as a whole. So it gives you the balance at the end of the first year. You can also calculate only the interest that you get for the first year. So 6,000 multiplied by 7 over 100, that gives you only the interest. And then you can add it with the principal amount and then get the balance at the end of the first year. So that way also you can show your workings, but this way it will give you the amount directly. Then the amount received at the end of the second year is 6,420 times 107 divided by 100. That is 6,869.40 rupees. Therefore, at the end of the 2 years, so which is after 2 years, the amount in the account is 6,869 rupees and 40 cents. Now, similarly, try all the other questions 3, 4, 5, and 6. And also try to complete the miscellaneous exercises. So we will discuss the other questions in our next classes. So that's it for today. We will meet in the next class.